Hello everyone, my name is Aashish and I am the Managing Director for Motilal Oswal Asset Management Company. Today I am here to give you an introduction to our latest offering, that is the Motilal Oswal Most Focused Dynamic Equity Fund. So basically this fund is, as the name suggests, it's a dynamic equity fund, and by the word dynamic what we mean is that linked to some kind of valuation parameters in the market, we will be enabling investors to calibrate their equity exposure up or down depending on where the valuations are. So, basically what we've seen is that we expect investors to remain invested in equity over long periods of time so that they actually create wealth. And as Motilal Oswal AMC, we ourselves spend a lot of our marketing bucks in order to propagate buy right, sit tight as a concept. Now, over the years, what we've seen is that while at our end, when we buy high quality, high growth companies on your behalf, our endeavor obviously is to buy right and sit tight on these long-term wealth creation equity portfolios. But at the same time, what we've noticed is that because equity markets inherently are significantly volatile. Just to give you example, at the time of my talking to you, in the last 1 year, we've seen the index at 9,000 and then back to 6,700, and right now again at a 9,000 kind of level. So while we are holding high quality stocks from a long term perspective, and while we are basically buy and hold investors, the fact is that however good quality companies we may be owning, there are macro factors at any point in time which result in huge amount of volatility in the market itself. And it has been repeated many times that the return on the investment is not the investor's return, and that is because these kind of huge ups and downs in the market, they act on the psychology or the behavioral traits of investors. And there are a lot of times when markets are down, investors are compelled to be fearful, and when markets are up, investors tend to be greedy. And we all understand that at times when markets have run way ahead, it makes sense for us to rebalance our asset allocation and book profits. And at the same time, when markets are significantly down, it makes sense for us to again review our asset allocation and increase exposure to equity. And all of this has to happen while we continue to hold high quality stocks on your behalf. While the expectation is that higher levels the asset allocation should be rebalanced away from equity, and at lower levels the asset allocation should be rebalanced in favor of equity. However, this remains to be a pipe dream or more of a theoretical thought process, whereas in practical life what happens is that when markets are at 9,000, investors tend to be greedy, and when markets are at 6,700, investors tend to be fearful. So the concept of a dynamic equity fund is to ensure that these kind of decisions which get distracted by way of emotional or behavioral reactions, it's best that such kind of decisions are taken out of human hands and they are linked to certain kind of automated systems whereby the right decisions are made at the right times. So let me tell you a little bit about MOVI, which is Motilal Oswal Valuation Index. This index is basically formed out of an algorithm which is a hybrid of the P, the price to book, as well as the dividend yield on the market index. So just to give you an example, the typical range in the last 15 to 20 years, by backtracking and extrapolating, the typical range that we have seen on the Motilal Oswal Value Index is somewhere in the range of 70 to 140. And what we've seen is that when the index is below 70, one should ideally be fully invested or have 100% exposure to equity. And when the index is say above 130 or 140, one should move towards liquidating equity exposure. Just by way of reference, while talking, when I'm talking to you, we are at somewhere about 105 on the value of the MOVI index. And at these levels, it is broadly suggested that the equity exposure should be 55 to 60%, whereas in the range of 40 to 45% should be held in fixed income or cash and cash equivalents. So basically what we will be doing at our end in as far as dynamic equity fund is concerned is that we will run a high quality, high growth multi-cap portfolio as far as the equity exposure is concerned, and then in sync with the level of the Motilal Oswal Value Index, we would be maintaining the equity composition of the fund, that is this multi-cap fund. The equity composition of the fund would be in synchronization with whatever is suggested by the value index, and rest would be held in form of passive debt. By passive debt, what I mean is that we don't expect to take any aggressive duration calls or any aggressive credit calls. basically you would expect that we would hold fixed income papers in the range of about 1 year maturity with the highest possible credit. So the idea is to run a multi-cap portfolio and at the same time enable the calibration of equity exposure depending on market valuations. So this is the short description of what we endeavor to do with the dynamic equity fund. In terms of a couple of important points lastly that I would like to share is that while there is a tendency to compare this kind of fund with equity funds, let me explain to you that if you compare this with a plain vanilla equity fund, the returns may or may not match up to what an equity fund would generate, because there will be significantly bullish times when equity funds would outperform this kind of fund. Because as you will appreciate with this kind of fund, as you go higher and higher on market levels, you start booking profits, and as you go lower and as you go higher and higher on the market levels, you start booking profits. So it's a good chance that you might miss the top 10-15% of the market movement, and at the bottom of the market there is a high chance that you would be holding significant cash, and the early part of a market rally would also get missed out. So typically, because with this kind of calibrated approach, you are likely to miss the top and the bottom. So I won't be surprised if this kind of fund actually underperforms an equity fund in bullish market circumstances. So the right way to look at this fund is not to benchmark it to an equity fund in terms of return expectation, but yes, my experience and the past data crunching that we have done tells me that while returns would be around an equity or a balanced fund, the interesting part is that this kind of fund cuts the volatility by about 40-50%. So while you could get comparable returns or slightly plus minus in terms of the average return, the interesting part is that this kind of fund can actually reduce volatility by about 40-50%. So this fund is basically not geared to give you higher return, but basically it is geared to give a more pleasant experience while investing. It's geared to ensure that you are not forced to react to market levels by way of emotions and behavioral biases, and at the same time it takes the emotion out and links it to a practical, unemotional, automated kind of model. So my sense is that while we buy right and sit tight on your behalf, this is something which is going to ensure that the journey or the ride is smooth and you do not get exposed to undue volatility. I would urge you to consult your financial advisor or distributor before you make any investment, or you are welcome to visit motilaloswalmf.com, and I would request you to read all marketing materials and the offer document before you consider any investment. Thank you very much for listening me out.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.